All right, good morning, everyone. I will just give it a few more minutes as we are waiting for people to join. I can see participants are ramping up in numbers as we go. So we'll give it a few minutes before we actually start. Just while we wait, if you're joining us, if you're on Zoom, if you go to the bottom of the screen, you'll see a little button that says Q&A with the two little speech bubbles. You can add questions at any time as we go. And what we'll do is I'll pause every now and then to have a read through the questions, and I'll try and answer them in the relevant part of the presentation as well. And especially if the question is something that might be useful for the wider audience, we'll answer them as we go. So please feel free, any questions are welcome. We'll go through that again just in a couple of minutes because I can see people are still joining us. We'll just give it one more minute and then we'll get started. Okay, and just to repeat, for those of you that are just joining, if you're on Zoom, at the bottom of the screen, you'll see a little Q&A button with the two little speech bubbles. Feel free to pop in any questions as we go, and I'll try and answer those, in the relevant section. I'll pause a couple of times as we go to sort of read through the questions and check that we're answering them as we go as well in the relevant section. All right, I think we should make a start. It's 3, nearly 4 past. I think that's good. Okay, let's get into it. So, morning everyone. My name's John Casey. I'm the Managing Director of the Accounting and Tax here at Virtuzone. This is one in a series of webinars that we've been running. For those of you that are joining us for the first time, welcome. Feedback is that these webinars have been very useful and especially answering some of the real questions that people have around the SME segment, the small business segment. And so hopefully, we'll go quite far in, reducing any fear that you might have around the corporate tax regime and be very clear about what's needed to be done. For those of you that are joining us who have joined previous ones, there's not too many updates since the last webinar that we had. We'll go through a little bit of clarity around some of the registration requirements. But other than that, not a whole lot of updates since the last one in December. But for those of you that joined, maybe an earlier 1 month ago, you might find some new stuff to be included here today. Okay, I will share my screen so we can go through the slides. And just a reminder, there's still some more people joining now. Just apologies to people that have already heard this. If you're joining on Zoom, at the bottom of the screen, you'll see a Q&A button with the two little speech bubbles. If you click on that, you'll be able to add any questions as we go. Sorry, ask any questions as we go. And what I'll do is I'll pause every now and then to go through those questions and answer them, so that we keep it relevant. Okay. So that's me. Yes, I do love tax. The t-shirt does not lie. So what we'll go through today will be very much focused, like I said, on small and medium companies, especially, I know there's a lot of startups that are looking for information. And what we will go through, so I want to cover off a lot of the basics today. So, the biggest question that we get is, does it even impact me? There's a lot of myths and a lot of misinformation out there around, does it impact free zones? Does it impact companies that only trade outside the UAE? Small businesses. We'll go through, the short answer is yes, it impacts all of you, but we'll go through exactly why. We'll run through the timing of what needs to be done, and then outline exactly what does need to be done. And then we'll get into a little bit more detail around, okay, well, will I actually have to pay tax? So, first question is not actually when am I taxable? It is actually, does it affect me? So, the short answer is every company in the UAE needs to comply with the corporate tax rules. Now, you'll notice I use the word company there. So if you have any kind of company, which, the technical way of looking at it is a separate legal entity, but if you have a company, so it's not a freelance license or anything like that, then this impacts you. It doesn't matter if you have a company which is named after yourself, it's still a separate company. And therefore, you have to go through all the compliance steps for corporate tax. It doesn't matter if you are in a free zone. It doesn't matter if you only operate outside the UAE, right? You might not have to pay tax, but you absolutely have to go through the compliance steps. So you'll need to register, you'll need to keep proper accounting records, and then you'll need to file a tax return as well. We'll go through, some more details around this later on, but the absolute sort of rule of thumb is it impacts every single company. There are no real exceptions to that. The only exceptions in terms of a business is around freelancers. So if you have a freelance license, so the correct term is around natural persons, right? So if you are trading under your own name and not under that of a free zone company, or you're not trading through a mainland company, and you just simply have a freelance license, then you only have to register if your revenue for the year goes over 1 million dirhams. So just to be clear, that only relates to freelance licenses, sole establishments, basically wherever there is no separate legal entity from yourself. So to be absolutely clear, the default would be that you would be registering. If you think there's a chance that you wouldn't, I'd suggest that you get confirmation of that before you sort of sit back and decide that, you're not going to do anything about it. And obviously, if your revenue is over 1 million dirhams, regardless of whether you're in a freelance or a sole trader setup, then you'll absolutely have to register and go through the compliance steps. Okay. Another part of the registration that has we've had a few questions around is around branches. So if you've just got the single entity, then this next part doesn't relate to you. But if you have multiple entities, or you have an entity with a branch, then there's a couple of, I guess, additional steps that you can take, right? So if you have multiple entities, so let's say you have 2 or 3 companies here in the UAE, if you own, or the ownership is common, more than 95% of those entities. So if you own more than 95% of, say, 3 entities, then those entities can be combined into what's called a tax group. And so effectively the tax authorities view that as one entity. The other, and that applies if you own more than 95% of 2 or more than 95% of 5, or if you have a holding company that owns more than 95% of, multiple entities. Basically, if that ownership threshold is or that common ownership is more than 95%, then those entities can be combined into a tax group. They register separately, but then they get applied and, to form a tax group. And that just makes the compliance side of things a bit easier. However, it can impact, your eligibility for thresholds around, or eligibility for exemptions where there are revenue thresholds, but we'll get to that. Again, if you only have one entity, then that doesn't relate to you. It's only if you have multiple entities here in the UAE. The other question that I had a couple of people have asked is around branches. So people asking, I've got a free zone entity with a branch and another free zone, and or cross jurisdiction branches. So the FTA have been very clear that a branch is simply part of the same legal person as the parent, right? So if you have a free zone, if you have an entity in one free zone and a branch somewhere else, there's only one registration, and that is under the free zone entity. So that will be considered a free zone person in the free zone that you're in, that the parent is in, sorry. The branch is not a separate legal entity. It's not seen as it is not a separate legal taxable entity. It is part of that parent. So again, if you don't have a branch, don't worry about that. It's just clarifying one of the questions that's come up a couple of times. For most of you, you'll have a company, a separate legal entity. And so, the rules apply regardless of where you're registered or where your revenue is coming from, or, or the size of the amount of the revenue that you're earning. It doesn't matter in terms of the compliance steps that you need to go through. It will matter whether or not you pay tax, but it doesn't mean that you can sit back and just sort of do nothing if you're under the threshold, for example. You need to run through the actual compliance steps, which we'll get to in a second. The next big question that I get is around timing. So let's say we've established that, yes, you do need to go through the compliance steps. So when does it all apply to you? The general rule is that it all kicked in for most companies from the 1st of January. So you should already be underway with your accounting. If you're not already, then you should be getting onto that. You should be getting underway with your registration. Now, obviously you won't file a tax return until later, but for the vast majority of UAE businesses, this all kicked in on the 1st of January. There are a couple of exceptions to that rule. So one exception is if you only started or formed your business after the 1st of June 2023. So let's say you just created your business, towards the end of last year, or in July or June or July last year. That means you were actually taxable straight away. So you need to have been going through those compliance steps from when you formed the business in the second half of last year. The other exception to that 1st of January rule are companies that are based in Dubai World Trade Center, so DWTC. The reason that is slightly different is that DWTC doesn't necessarily follow the January to December financial year. So what you need to do if you're registered in DWTC, you need to go and check your Memorandum of Association, your MOA, or your Articles of Association, AOA. And then I think it's on page 5 or 6, there'll be a section that is called fiscal year. And fiscal year will show what financial year you have. And basically, if you have a financial year that starts from June to December, then or June to January, sorry, then you are already taxable, and you would have been taxable since last year. But if you, or unless you're in January, but if your financial year starts in February through to May, then you haven't started tax yet. That is just for DWTC, Dubai World Trade Center companies. For everybody else, you should have been, you started or you became taxable on the 1st of January, so a couple of weeks ago. So you need to be underway with all of your, financial records. I'll just quickly jump to the compliance steps for a second, and then we'll jump back. So the compliance steps are pretty much the same for every company, right? So you'll need to register for corporate tax. You'll need to do proper accounting records. Okay, so those accounting records need to be done to IFRS standard. And then after your first tax year, you'll need to file a tax return. The most important one right now is around your accounting. So, and apologies, I'm jumping around a little bit, but I'll just pop back to the accounting slide. So you should have been, or you should have started your accounting already from the 1st of January. Now, the accounting standards can vary slightly depending on the size of the business, but the general set of standards that accounting needs to be done to is called IFRS, so International Financial Reporting Standards. You absolutely do not want to be waiting until, the end of the year to try and, retrospectively do all your accounting for the year, because I can guarantee you there will be mistakes, there'll be omissions, and then you run the risk of not only fines, but also, not having the adequate support to file for an exemption or to file for a relief rule. I've got a question here around, how far back should I go with the records? Look, I would suggest that you at least have your closing 2023 accounting records there, so that you have, your opening balances for 2024. And then you absolutely must have your accounting records starting from the 1st of January 2024. Now, the accounting is, also very significant, because this is where we see some of the larger fines. So the fine for not keeping correct financial records starts at 10,000 dirhams. And then it goes straight up to 20,000 if you can't resolve it. And then, you get fined each year thereafter. So it is, extremely important that you get onto this. There's no benefit in waiting. I've spent a lot of time in the accounting industry, and I can tell you that if you wait until the end of the year, you're just going to pay more, because it's going to be more work for an accounting firm to try and backdate all of your accounting. It's a lot easier if you get onto this now. It's only 2 weeks have gone by, so it's not too much to catch up. And then you can get underway, be on top of it. The way that we operate here at Virtuzone is you can just dump your documents onto us with any regularity that you want to, and we ensure that it's all been accounted for correctly. Please don't wait until 2025 to try and do your 2024 accounting, because you'll end up paying more, you'll end up getting, exposing yourself to fines, and of course you'll end up risking paying more tax or missing out on an exemption or a relief rule. Okay. Another question here around timing. So, do I submit a tax return now or wait until June 2024? No. So, with the exception of DWTC clients, okay, so pretty much every company, and especially every company that follows a January to December financial year, you won't actually submit a tax return until the start of 2025. Okay, so in 2024, you need to do all of your accounting for the entire year, and then that informs, or that results in your tax position for 2024, and you only file that in 2025. Okay, so you can't show your 2024 tax position during 2024 because you're still within the year. So it's not until next year, the start of next year, that you actually file the 2024 tax return, and that's how sort of the rest of the year works. Currently, there is no requirement for what's called interim tax returns or interim tax payments here in the UAE, which is what we see in other jurisdictions. So there's only one tax return that needs to be filed, which is after the end of the tax period. So your first filing will be at the start of 2025. But like I said, if you wait until then to do, before doing anything, then you're going to have a very hard time doing all of your accounts retrospectively. And accounting firms tend to take advantage of that a bit and charge a bit more, and it becomes a lot more difficult. There's another question here around exemptions, which we'll get to. So, look, I hope that's very clear around the accounting requirements. Like I said, this is the piece that you really need to be on top of more urgently. So right now, as well as obviously the registration, but this accounting will sort of dictate where you land in terms of how much tax to pay, or if you have tax to pay at all. It's probably just as important to have some kind of consultation at this point. We obviously do free consultations here at Virtuzone, just to make sure that you're operating everything correctly, because the way that you issue invoices, for example, can impact whether or not you qualify for an exemption. And if you wait until the end of the year or 2025 to have that discussion, then unfortunately you won't be able to go back and re-invoice all your clients. So you may end up paying tax where you didn't actually have to. Okay, so the big question is, will I pay tax? Now, we'll talk about this from the point of view of a free zone company. Okay, so there are multiple layers that you need to fall through as a free zone company before you actually pay tax. So the first thing that they look at, so the first exemption that you can look at is called the qualifying free zone person exemption. All right, and the largest hurdle to get over to qualify for this is around what's called qualifying income. So I like to categorize qualifying income into two buckets. Okay, so the first category looks at the geography of your clients. All right, and this rule or this category says if you're a free zone company and you only sell to other UAE free zone companies, right, then you should meet the qualifying income criteria. Okay, the key here is that it needs to be UAE free zone, right? So not outside the UAE, not mainland UAE. It needs to be inside the free zone bubble, right? So to be very clear, selling outside the UAE does not count towards this. So inside the UAE free zone bubble, and it needs to be sales to a company, so not to an individual, right? So another free zone company. Now, obviously you can't sell to a free zone individual because people can't be, a free zone company. So that's the geography test, right? And so there is a threshold. So 95% of your revenue needs to come from UAE free zone companies. The next criteria, or the other criteria that can be looked at, is what's called qualifying activities. Okay, so let's say you're a company and you sell in the free zone, but also you sell overseas. You have all your or for example, you have all your operations overseas, or you sell on the mainland. You can still qualify under the qualifying income criteria if you are doing what's called a qualifying activity. Now, I do have a list of these on a slide here. Now, as you can see, the list is not huge, right? It's very specific around heavy industry, financial industry. In general, services aren't really included here. So, if you're a marketing company, you're providing marketing consulting or management consulting or IT consulting, for example, you won't meet, or it's very unlikely you will meet the qualifying activity category. So quite a common client that I have is, someone based in a free zone, registered in a free zone. They have clients inside the UAE, or a better example, they live in Dubai. They've got a UAE free zone company, and all of their clients are outside the UAE, and they are doing marketing consultancy, right? That type of client will not qualify for the free zone exemption, all right, because their clients are not in the UAE free zone, and their activity is not a qualifying activity. So it's the same for marketing consultancy, same for management consultancy, same for IT consultancy. Pretty much all of those service-based companies in the free zone with offshore clients will not meet the free zone exemption. However, there is another level of exemption that you can avail. The next layer, if you don't meet the qualifying free zone exemption, is a thing called the Small Business Relief Rule. Now, this rule is, I think, a very generous rule and a very favorable rule from the government here. They have basically said, look, if you are a small business, we don't want to bother you just yet with corporate tax. And what they've done is they've defined small business at a very high level. So they've said, if your revenue, so your gross turnover, your gross income, your top line revenue, if that number is less than 3 million dirhams, you don't have to pay any corporate tax. Okay. Now, to be very clear, you still have to go through all the compliance steps, especially accounting, because you need to prove that your revenue is under 3 million. But if you can prove that your revenue was less than 3 million dirhams, then you can file for the small business relief and you won't have to pay any corporate tax. So I have a lot of clients, using that example before, who have a marketing consultancy with, clients outside the UAE, who won't meet the free zone exemption, but they will be under 3 million, so they won't be paying any corporate tax. I might just jump down and do a quick little comparison between the free zone exemption and the small business relief before we go into a taxable business. So, So small business relief is great, and it will be a little bit easier to qualify or to get the small business relief exemption than it is to get the free zone exemption. So a company who qualifies for both might be tempted to just opt for small business relief because it's easier and it doesn't require an audit, which the free zone exemption does. Now, we would not recommend that. So the reason being, if you qualify, or if you have a way to qualify for the free zone exemption, it is always preferable to go down that road. The reason being is yes, it actually requires an audit, so there's a little bit of extra admin work involved. However, there is no expiry date on the free zone exemption. So if you qualify for the free zone exemption, you can keep doing that for, I think it's another 50 years or 99 years, basically, as long as the free zone is in place. Contrast to small business relief. So small business relief is a temporary relief rule, and it's only in place until the end of 2026. So basically, if you qualify under small business relief, you can only avail that rule until the end of 2026, and then in 2027 you will become a taxable business. So if you are in a position where you have the option to go for the free zone exemption, you meet those strict criteria, then I'd recommend you always go for that over the small business relief. If you opt out of the free zone exemption, so if you qualify for the small business relief or you don't qualify for the free zone exemption, you cannot go back to the free zone exemption for 5 years. Okay, so there is a temptation with businesses that are small to opt for the small business relief over the free zone exemption. I just would not recommend that, because small business relief ends in 2026 and you'd be stuck in the small, as a taxable business for another 2 years before you can go back to the free zone exemption. Again, that only is relevant if you meet both criteria, but from what I've found, most businesses that I've spoken to don't actually meet the free zone criteria, so they're looking at the small business relief. Okay, so let's say that you do not meet the free zone exemption. Your revenue is more than 3 million dirhams, right? So let's say your revenue is 3.5 million dirhams. What that means is that you are a taxable business. And so what happens at this point is that the FTA stops looking at your revenue and your revenue sources, and they start looking at your profit. So your revenue less your expenses. Now, the tax rate on profits is 9%, but only on your profits over 375,000 dirhams. So let's say, you're a business with 3.5 million dirhams of revenue, and let's say you have 2.5 million dirhams of expenses. That leaves a profit of 1 million dirhams, okay? So the way the FTA will tax that profit of 1 million dirhams is the first 375,000 dirhams is tax-free, and then the remaining 625,000 dirhams is taxed at 9%. Okay, it's a flat 9% rate regardless of how high your profit is on those profits over 375. Okay, we've got a couple of questions here just back on the free zone exemption. So I'll go through it again. I know it's a little bit confusing. So the free zone exemption, I'll just go through the criteria again. Actually, we'll go to the actual free zone. Here we go. So the biggest hurdle is meeting the qualifying income criteria. So we'll just go over this again, and I'll go through the other criteria as well. So to meet the qualifying income criteria, right, you need to meet one of two categories. There's actually three, but only two are really relevant. So your income needs to come from, or your clients need to be within UAE free zones. So they need to be UAE free zone companies, not outside the UAE or inside the UAE, right? That's one category that you can meet. So if you are let's say you're a company based in Meydan free zone, and you have one client in DWTC and one client in DMCC, right? That means that all of your revenue is coming from UAE free zone, other UAE free zone companies. So you would meet the qualifying income criteria. You can have up to 5% of your revenue coming from, outside of that. So they have a little bit of leeway, but the vast majority, 95% of your revenue needs to come from, other free zone companies. So that's one category. The second category, right? So let's say, or the other category, let's say that you have clients outside of the free zones, right? You can still meet the qualifying income criteria, but only if your income comes from what's called qualifying activities. So this list of activities is very specific, and it's very much focused around heavy industries, so shipping, aircraft parts, manufacturing, logistics, or it also is focused on financial services, so reinsurance, wealth management, fund management, those sorts of things. What we find is that, or what's quite clear is that if you are providing consultancy services, this doesn't meet the qualifying activities criteria. So, just going back over common clients, common clients that I have, people who have a marketing consultancy and their clients are overseas, they would not meet the qualifying income criteria and would not get the free zone exemption. Just to add to, go through the other requirements of the free zone exemption. So if you do meet that qualifying income hurdle, there are a couple of other hurdles you need to jump through. The biggest one is you need to show what's called adequate substance in the free zone. So anyone who's been through the economic substance regulations, process, you know that you have to show that you are actually running the business here in the UAE, and it's not just here as a tax shelter to move profits around. So there is a slight difference here, where if you've been through the ESR, it's showing the existing ESR process is about showing substance here in the UAE. What the free zone exemption will require you to do is show that you've got economic substance in the free zone itself, so that you need to show that you're actually running the business from the free zone, right? And that you're not just holding an entity in the free zone to avoid tax. We don't have a whole lot of guidance around this. All that the tax law says is that you need to show adequate substance relative to the amount of revenue being generated. They won't publish strict, very clear guidelines around this. Generally, it's around, how many employees do you have? Do you conduct all of your operations in the free zone? And this will be part of, I expect, what you need to file when we file for a free zone exemption in 2025. Okay. And the other hurdle for a free zone exemption is that you need to do an audit as well. So filing for small business relief and filing for a taxable, if you're a taxable business, you don't need to do an audit. You only need to do an audit currently you only need to do an audit under two circumstances. One is if you're going for this free zone exemption. The other one is if your revenue is more than 50 million dirhams per year. So, majority of small, medium companies and startups won't need to do an audit unless they are going for this free zone exemption. I've got a question here. Ali, does qualifying activities include medical device production or patent development? There is a rule around qualifying intellectual property. I'm not going to go into it here because it's quite complex. So for the patent development piece, it's all linked to how much you actually spend in developing that IP. It is quite complex, and you will need to have sort of separate advice around that. The medical device production, if you are doing manufacturing in a free zone, and then it should qualify for the exemption. Okay, but I'd really recommend that if you are doing both of those activities and you're earning revenue on the patent development, you'll need to get some somewhat detailed tax advice around that, because that qualifying intellectual property rule is a little bit complex. A question here from Dale: can I switch from qualifying free zone to small business if the nature of clients changes over the years? So Dale, I would not. So small business is only there for a few years. So you've only got this year, next year, and the year after for the small business relief. Unfortunately, if let's say, so I'd recommend obviously that you continue to file under the free zone exemption as long as you continue to qualify for that. And then the point at which, the nature of your clients change, you'll need to switch over to a taxable business. Okay. A question here from Pawan: if you trade in physical goods, will you buy from outside the UAE and sell to clients outside the UAE? Do you qualify under okay, I'll come to that in just a second. All right, I'm just going to answer another question first. Oh no, sorry, we'll jump to that now. Sorry, the next question I answer later on. So Pawan asked the question: if you trade in physical goods, for example, electronics, will you buy from outside the UAE and sell to clients outside the UAE? do you qualify for the free zone exemption under the qualifying activity, processing of goods or materials? So it's not actually processing of goods and materials, it's the distribution of goods and materials. So if you see qualifying activities, the third from the bottom. Now, the key difference here is around the words designated zone. So this rule says distribution of goods or materials in or from a designated zone basically to a reseller. So there's a couple of things here, and it's one that I want to discuss because this is something, and we call this a dropship model, right? This is something that the tax regime is allowing under their exemption, but only if you are registered in what's called a designated zone or a designated free zone, which is different from a standard free zone. So a designated zone is normally a gated or a fenced off area. So for example, JAFSA or Al Quwain, as opposed to a standard free zone, which is like, Meydan or DWTC, where it's an office space. For any of you who currently do, shipping or anything and have a entity in a designated zone, you'll know what I'm talking about here because they have specific rules for them around VAT. Right. So if you are a company or if your entity is established in a designated zone, right, and you operate a dropship model, so you ship from country A. So let's say you buy goods from China, ship them to Turkey. Okay. If you're a designated zone company like JAFSA or DAFSA, you will be exempt from paying corporate tax under the qualifying free zone exemption. Okay, you'll still need to prove it all. You'll still need to go through all the compliance steps. And it only applies under two conditions. One, that you are registered in a designated zone, so not a normal free zone, a designated free zone. And the second important part is that you are selling to a distributor or a retailer, right? So you can't be selling to the end user. So you can't be selling, stuff on Amazon where you're buying it from China and shipping it to individuals in the US or Turkey or whatever. You need to be actually doing it wholesale. You need to be B2B, selling to a further distributor. So Pawan, not sure if you are listed in a free zone or a designated zone, but what we are seeing is people who are registered in free zones and operate this model are now looking to sort of move their companies or close down and reopen in a designated zone. It's something that we are doing here at Virtuzone for a lot of our clients. If you are interested in this, by all means, please reach out to us. It's a very sort of common approach that is being done now. Question from Kenneth here. So a lot of this is around, showing where your revenue is coming from. Yes. So if you are filing for the free zone exemption, right, the purpose of the audit will be to show that your revenue is actually coming from where you're saying it's coming from. And obviously there is a bit of self-declaration here, right? So the same way that tax regimes operate around the world is that you file your tax return based on what you know, or you engage a accounting firm such as us to do it for you on the basis that it is correct, according to the law. And later on, if the FTA comes and audits you and they find that it's wrong, that is when you get into the serious trouble. But what's going to happen with with that free zone exemption is that they've got additional step of an audit, and there'll be an expectation that the auditors will be helping to verify the revenue of the source of the revenue. Okay, question from Dale. The free zone exemption, does that matter what the level of your revenue? No. So the free zone exemption doesn't look at the volume of your revenue. It just looks at the source or the nature of your revenue. So your revenue and your profits could be very, very high. And if you qualify for that free zone exemption, you're exempt from paying tax. Pawan, you just had a follow-up question. If your goods do come out of the UAE port, so if they come into, so let's say you buy from China, they come into the designated zone in the UAE, and then they get shipped out again to Turkey. I'm just using China and Turkey as an example. That's fine. They're basically treated as if, they never entered the UAE. So the same rule applies. So still in and out of a designated zone is fine. So you'll see the diagram that I've got on the screen. As long as it's in and out of a designated zone, so a port zone, then that's okay. Right, but it needs to be your, you need to be a company in the designated zone. So, okay. Jita, no, if you're in a free zone, not a designated zone, you're not exempt. So the question here is, we're in a free zone and we're running this dropship model. No, it only counts if you are in a designated zone. Okay, so I'm going to jump through a little bit to taxable business. So we've got 15 minutes left. So let's say that your company, so you didn't qualify for the free zone exemption for whatever reason. Your revenues are more than 3 million, right? So you become a taxable business. Now we ran through the example before where, let's say your revenues are 3.5 million, you had 2.5 million of expenses, so your profit was 1 million, right? That means that you'd pay 0% tax on the first 375,000 and then 9% on the remaining 625,000 that gets you up to that 1 million dirhams of profit. So you pay, let's say around 60,000 dirhams of tax. What kind of expenses can you deduct? And Gita, you had a question around this, I see. So, oops, sorry. So the most common, so if you are a taxable business, right, then we go into the same sort of games that we play all over the world around deductible expenses. So we have, the most common question around deductible expenses are, can the owners just pay themselves a big salary and deduct that? So the short answer is not really, right? So you can pay yourself a salary if you're a shareholder. However, there are two parts to this, right? So the first part is you need to be in a position from a compliance perspective to pay yourself a salary. So, if you are on a investor visa, for example, you can't be an employee of your company if you're on an investor visa, all right? Whereas if you are listed as an executive director, you can be an employee of the company, right? So, so step one is, are you in the correct position from a compliance perspective to be able to pay yourself a salary? Step two, assuming that you are able to be listed as an employee of the company, so you have your labor contract in place and everything like that. Step two is, all right, well, how much can you actually pay yourself? And this is where we get to these rules called connected person rules. The rule of thumb there is that any payment to a connected person, so be it a shareholder, a director, the shareholder's spouse or children or grandchildren, or any transactions with connected companies, they all need to be at what's called arm's length market value. So when it comes to salaries, you look at, all right, if that person were to go and get that same role for an unrelated company, all right, so went out on the street, got a job, for the same job for another company, what would they earn? What would their salary be for that role? Okay, so if you've got, if you've got 4 million dirhams of revenue, you can't just go and pay yourself 4 million dirhams of salary and say that's a day. You would need to be ensuring that you are paying yourself an appropriate salary for the work that you're doing for that company, right? With the remainder of any other distributions going out to shareholders or connected persons would be, for example, payments out to a shareholder would be treated as dividends. Okay, when dividends are not tax deductible, dividends are paid after tax. So the question that Gita had was expenses incurred on behalf of shareholders. Okay, so if that shareholder is, like I said, an employee or able to be listed as an employee, then expenses incurred for that shareholder, so let's say you're paying their rent or their insurance premiums or something like that, that would just be treated as part of their remuneration, right? Their total remuneration, and that would be under, that would be tested as if it was, the same way. Is it appropriate for what that shareholder is doing as an employee for the business? If that shareholder is not an employee, then any expenses incurred or any money paid on behalf of the shareholder would just be treated as a dividend or a distribution and would not be tax deductible. The other question we get a little bit is around entertainment. So, if I take some clients out to lunch, can I deduct that as an expense? The answer to that is you can deduct 50%. So you can deduct half of that expense. So if you take some clients out to lunch and you spend 1,000 dirham, you can only deduct half of that off your expenses. Sorry, off your profit. Okay, and again, these rules that we're just going through now about paying yourself a salary, deductible entertainment, this only becomes relevant if you've fallen through all those other exemptions. So if you don't qualify for the free zone exemption, you don't qualify for small business relief because your revenue is too high. It's only then when you become a taxable business that you need to start looking, or you need to start really thinking about these, these kind of deductible expenses. With that said, also keep in mind that if you are qualifying for the small business relief, you should really be looking at putting these things in place before, sooner the better. So you have a bit of a track record of these, but absolutely before the end of 2026, because in 2027, small business relief stops and you'll need, you will be a taxable business. So just a reminder, every single company, it doesn't matter if you're qualifying for small business relief, doesn't matter if you're, free zone exempt company, it doesn't matter, even if you have no revenue at all, right? So we do, people call them visa seeker companies or seeker companies or whatever. If you have no turnover, non-active business, even those companies still need to go through these steps. So every company needs to register, every company needs to, keep proper accounting records, and then every company will need to file a tax return to show, their taxable position. It's not like VAT where, you only have to do it if you go over a certain threshold or something like that. It's the opposite, right? So every company has to do this, and you need to prove if you're not paying that, that you don't have to pay corporate tax. The only additional compliance step is around the qualifying free zone. So the free zone exemption, you also need to do an audit like we mentioned. Okay, so how to do all of this? Now, this is, unfortunately, we were running a free compliance package. However, we hit our target of, we went out for 10,000 companies. There was a huge response. So whilst the free package has now expired as at the end of the year, we are still providing free consultations, and we still have, fantastic, and I'm very, we know that our price point in the market is excellent, and our service is excellent. So you can still go to Tax Ready. You won't be able to claim the whole free package, but we're still doing free consultations and packages which include, obviously accounting, but also free tax registration, and get you completely compliant. Just quickly, Dale has asked a question about VAT. It is a very common question that I get, so I'm going to answer this. I know it's going outside corporate tax, but hey, let's do it anyway. So Dale's asked, he said, my clients are outside the UAE and the service is done outside the UAE. When I invoice them, should I include VAT? Okay, so you should so it is completely illegal to charge VAT if you don't have a VAT registration number. Okay, so that's rule number one. Rule number two is that if you are providing service outside the UAE, so it's an export of service, you don't charge VAT on those. Okay, so you still include the VAT number on your invoice, but you charge VAT at 0% effectively. You only have to charge VAT, A, once you have your VAT number, so your VAT registration, and B, for clients based in the UAE. Now, there are some exceptions, some exceptional cases around this. If you're invoicing someone outside the UAE, but you provide the service inside the UAE because they're here visiting or something, that's when it gets a little bit complex. But the general rule is that if you're providing services outside the UAE, then you're not charging VAT. Now, the next question is, and this is one we get all the time, if you are only providing services outside the UAE, do I still need to do a registration? The answer is yes, but you do what's called an exception. So you have to still register. So the best way of thinking of it is every business still needs to go through a registration process when their revenue hits 375,000 dirhams in any 12-month period. So rolling 12-month period, if you hit 375,000 dirhams revenue in that period, you have to go through a registration process. Now, if you have clients inside the UAE, that will just be a standard registration, and you'll start charging that. If you only have clients outside the UAE, that registration will be what's called a VAT exception. And that's basically the FTA saying, yep, cool, thanks for letting us know that you've hit the threshold. We agree that you're not going to be charging VAT to anyone, so don't worry about filing the quarterly VAT returns, which is quite cool. So they basically give you an exception from having to file the VAT returns, but you still have to let them know. Where this gets a bit tricky is whenever your business hits that 375,000 dirham threshold, you only have 20 working days or 30 days to get that registration in. Otherwise, you get hit with a one-time 10,000 dirham late registration penalty. Okay, so that applies to every business. As soon as you hit that 375,000 dirhams, you've got 30 days to register, and then you get hit with that 10,000 dirham fine. Now, this might sound alarming because quite a lot of companies will be hearing this for the first time, we find, because someone has told them, somewhere in their history that if they're only doing exports, they never have to worry about VAT, which is not the case. But let's say you hit the VAT threshold back in 2021, right? It doesn't matter if you go and file for the exception now, as long as you've only been making supplies outside the UAE. So you file for the exception, and then what you do is you'll still get that 10,000 dirham fine, but you don't get additional penalties on top of it. So it's just the one-time fine. It doesn't accrue interest. It doesn't accrue additional filing penalties or anything like that. It just will be that one-time 10,000 dirham fine. So don't worry. Yes, it might be alarming that you might have a 10,000 dirham fine that you didn't realize before. But don't worry if it's been, if it's 2 years late or something, it doesn't make a difference. It's still going to be just the 10,000 dirham. Obviously, very different if you've been making supplies inside the UAE and you hit the threshold and you never registered and you've been making supplies for 3 years, then you've got a very big issue because you've got 3 years of VAT owing and filing fines and everything like that. So that's a very different case. But if you've only been making supplies outside the UAE and you hit that 375,000 dirham threshold, a while ago, you'll get hit with the 10,000 dirham late registration fine, but you won't get any, that won't be it won't have accrued interest or additional late payment penalties or anything like that. Okay. Michael, yeah, there's a VAT registration. There is a voluntary threshold of 187,500. So yep, you can go and register once you hit 187,500. The mandatory one is 375,000. So yes, you can go and register, but only if you're doing a standard registration. Once you hit 187,500, but the fines only kick in at 375,000 dirhams. So you basically got a window to go and file, sorry, to go and register. But then once you hit 375,000, you've only got 30 days. And you can only register for the exception once you hit 375. So it's a very sort of time sensitive thing. So you need to be measuring by the day what your revenue is. And when you hit that 375, if you're only making supplies outside the UAE, you need to go and do that registration quickly. Question from Chris: if you do the late registration but are found to be an exception, does the AED 10,000 fine still apply? Yep, yeah, it does. So the difference is if you do the late registration and it's an exception, then you only get the 10,000 dirham fine. But if you do the late registration and you were supposed to have been filing VAT returns and paying VAT, that's when you have not only the 10,000 dirham fine, but a lot of subsequent fines on top. That's when you have quite a serious problem. Okay, we'll end it there. I hope the little VAT part was useful as well. So again, if you have any further questions around this or want to book a free consultation or anything at all, get in touch with us. Just go to taxready.ae. You can contact us through there. One of us will reach out to you, or you can book a consultation directly on there. The team know all of the rules around corporate tax. They'll get you set up with the right package, including the free corporate tax registration. And hopefully we'll see you there, and hopefully we will talk again soon. So thank you everyone, and we'll see you at the next webinar.